For those of us that lived through the late 90s, in March 2000, the 12-month forward earnings multiple on the S&P 500 was 24.5. Today, it's 23. So can we continue to have multiple expansion? Yes, but we are in rarefied air. When it matters, I have no idea, but I do know there's no margin of safety right now.
Welcome to the Risk Reversal Podcast. I'm Dan Nathan. I'm joined by my very good friend, Peter Boockvar. He is the CIO at OnePoint BFG. Peter, new name, same firm. You rebranded. What's going on there really quickly?
Hey, Dan. So Bleakley was a guy's name, one of the founders 40 years ago, and he left probably 35 years ago. But we kept the name, and we just felt it was time to go from a name to a brand. OnePoint being one point of contact for all your financial needs. And that was the main reason.
I love it. You also write the book report that is on Substack. It's Boock report, I think, at Substack. So go check that out. It's a great read. Peter does a number of write-outs throughout the day on everything going on, from economic data to earnings to just a whole host of macro stuff too. So check that out. All right, Peter, we have one job and three topics. It is trade tariffs, it is Fed data, and it is earnings. Let's hit those quickly in that order, I guess. Let's talk about, we come in here, it's Monday, we're recording this on Monday afternoon. We have another trade deal, this one with the EU. It's like a framework. It's also a big commitment for the EU bloc to be buying our stuff. Energy was the big one here. I just want to read a couple headlines from the Wall Street Journal really quickly. Euro drops as trade deal prompts pushback in Europe. Investors welcomed an end to the trade deadlock, but tariffs of 15% are seen slowing European growth. Trump's $750 billion EU energy deal collides with market reality. Europe has pledged to increase purchases of American energy, but exporters may struggle to meet demand. It's a nice number. This is Warren Patterson says at ING Bank. You essentially have to divert all energy trade. That's just not possible. All right, let's talk about what was announced and what we got.
Okay, so on the energy piece, the $250 billion a year for the next 3 years, Europe, I think, imports from us about $75 to $80 billion worth of energy. But Europe was shifting this way anyway to us because they were further shifting away from Russia. And when you're dealing with a commodity, a fungible product, whether Eurozone buys from us or somebody else does, we're still selling our oil, our natural gas, and our LNG from someplace. Because if Europe bought more from here and bought less from us, well, if they buy more from us and sells less to them, then it just gets shifts around. So there's still the same amount of aggregate purchases of energy because the same amount of people need to turn the lights on and their heating during the winter and the air conditioning during the summer. So I think we were shifting to this direction anyway because the U.S. is the Saudi Arabia of natural gas, and we are developing this LNG, these further export terminals. So we were selling to the rest of the world anyway. This just sort of maybe codifies it, if there is codification of this. You know, in terms of Europe with the $600 billion worth of funds coming our way, I don't know how logistically that gets pulled off when you got 27 different countries. There's not this slush fund at the European Union that can just send us money. Like Japan's one country. Japan can control those funds. Europe, I don't know how that's possible. I think at the end of the day, can we sell more stuff to them? Maybe, maybe not. There's a reason why Europe doesn't buy our SUVs. If you go to Europe, most of their cars are smaller because gasoline is like $7 or $8 a gallon. They can't afford to buy our big cars. So yeah, is Ford and GM going to sell more cars because the tariff rate is now 2.5% on our vehicles versus 10? I don't know. Ford basically got out of the business of selling small cars. Are they going to now get back in because they can sell to Europe? I don't know. I think that the Germans are not happy because of the 15% tariffs on autos that are still left. But still, at the end result, we got to calculate, and you've done this, of what the tax is on U.S. businesses and households, because in some of the studies I've seen, the American business, the American household is going to be eating most of these tariffs. And yes, there will be some exporters to us that will reduce price, but the weakness in the dollar is sort of offsetting that. We're going to pay for most of these tariffs. And all throughout the earnings calls that I've listened to, they've talked about it. And to the goal of reshoring manufacturing to the US, yeah, I hear that in bits and pieces, but no more than bits and pieces. A lot of businesses are just sort of resorting their supply chains, but I don't hear all this commentary about bringing manufacturing jobs back to the US. So I think the net result is going to be a global drag on growth. But now we get to see it. Dan, when you think about the markets from the April 9th, okay, we're taking a pause. Every subsequent rally came about, we're close to a deal. We have a deal, and then we would rally on the deal, irrespective of what the details of that deal was. Now, from here, since most of the deals are now done outside of China and Canada, now we get to see, okay, what are the details of the deal and what's now the economic impact of these deals?
Yeah, it doesn't seem like there's a lot of detail. Like every single one of these deals, going back to the UK deal, obviously you mentioned Japan, the thing that we got in Vietnam. It seems like there's a lot of quid pro quo. I think these deals would have a lot more, I guess, credence, if you will, if they didn't all like sunset after 3 years. We know what happens in 3 years, right? And it seems like, going back to Stargate and a whole host of these other ones, Apple said they're going to spend, 500 billion, 125 a year over the next 4 years. It just seems like they're placating, a guy who wants to kind of, notch up some deals, which I guess makes perfect sense. Like what Jensen Huang just did with NVIDIA, right? He did exactly what he needed to do to get these export bans lifted in the meantime, that sort of thing. So again, it is what it is. Do you think though that ultimately when the rubber hits the road that we are left with, and you were talking about this on CNBC and the book report on our podcast last week, that if we have a tariff rate of 15, 17% or so, basically across the board. And you just said it. I mean, ultimately, we are going to eat that tax. The White House can kind of say, hey, we're taking in $25 billion a month. Look at how well we're doing. But if it's U.S. corporations and it's coming out of their earnings, or it's U.S. citizens, right, and it's coming out of their spending power, doesn't that present a problem here for U.S. growth? And isn't that much more reason why the Fed Chair Powell is stuck on two sides of this fence here a little bit, right? They're worried about growth weakening, right? But they're also worried about inflation picking back up. So maybe we can just segue a little bit into what your expectations are for Wednesday afternoon when Fed Chair Powell takes the podium.
So on the belief and things that I've read, I mean, Goldman Sachs thinks that the U.S. economy is going to eat 80% of these tariffs and foreign exporters to us just 20%. So when we hear that all the money we're taking in, that is basically money coming out of the private sector, going to the federal government with, if Goldman is right, 80% of that money suck coming from American households and businesses. That is a growth depressant. And what are we seeing so far in the first half of 2025? Early on in the second half? Well, growth is averaging at about 1%. So we've already seen evidence of the negative impact from this tax, because that's what it is. Now, Jay Powell's dilemma is, yes, trying to gauge the inflationary / tax impact of the tariffs to see what the flow through is outside of the one-time impact, but also the negative economic impact, of course. But there's another thing here, is when you look at the financial markets, financial conditions are as easy as they can be, whether it's credit spreads, it's market multiples, whether it's the meme stock craze again, the Bitcoin, whatever. How do you balance all of this? And, the Fed wants to, pays attention to financial conditions when they're tight, not necessarily when they're easy, but they're pretty damn easy when you look at the market that is seemingly going up on a daily basis. And as you and guys say, it's going up because it's going up and we're open, so it goes up.
Exactly. As far as, as Guy likes to use the term browbeating that Fed Chair Powell has taken, from President Trump, and we saw that kind of split screen, if you will, of the two guys standing next to each other with hard hats on and kind of debating a little bit.
How uncomfortable was that, Dan? It was so awkward, not only for them, but just to watch.
By the way, Powell looked really small. I mean, relative to Trump, it like he looked like he could have been. I don't know. I mean, it was just really interesting, like the visual there, and like Powell. I mean, came across as somebody who looked very defensive, obviously, and he just did not look particularly comfortable. And I think it's a very different thing when we see him walk up to the podium Wednesday afternoon. I mean, he has an air about him. You know what I mean? He has a level of confidence, and I guess that's really the only way you can be with the president of the United States on live TV. We saw it with Zelensky, a few months ago. It's just a really difficult spot. You're in a no-win situation. Do you think, though, that experience changes Powell's mind whatsoever about how he presides over monetary policy? Now, this is supposedly the first meeting in decades where you're going to have two dissenters about policy. So how are you going into this event here? Fed funds rate, the CME Fed tracker is suggesting like nearly a certainty that they will leave policy unchanged. But as we get into September, it hasn't moved that much, Peter. It's basically a 65% probability it's a 25 basis point cut?
Yeah, for a second. I mean, there haven't been many more Fed critics than me since going back to Greenspan. So I'm not a fan of the institution. But to your question and point, I do think Jay Powell, the only thing he cares about right now is his legacy. He knows he's out of there soon. And the last thing he wants to be seen as is a lackey for Trump. And to have Powell cut just because Trump wants him to cut. And Powell knows that lowering government interest expense as a purpose of monetary policy is the behavior of the Weimar Republic and other third world countries. And Jay Powell wants no part of that. Now, if he cuts rates, I genuinely believe that he's doing it because he thinks it's the right thing to do in terms of his views on inflation and its trajectory and where he thinks the unemployment rate's going to be, which means that, of course, they're meeting Wednesday and he's not going to be able to respond to Friday's unemployment rate. But you can be sure if the jobs number does see further weakness, he'll be more comfortable cutting in September, but he's going to do it upon his own volition and not because he's bullied. And to your other point, yes, if Waller has a backbone, he will dissent because he told us he thinks they should cut rates this Wednesday. Michelle Bowman, I guess, can go either way, even though she would like to cut rates too. But Powell still has a bunch of support throughout that committee, both voters and non-voters, if you look at a lot of their speeches over the past bunch of weeks. So it's not like Powell is just standing out on an island unto himself, not wanting to cut rates because of the bullying from Trump. He does have support within the committee. And he does have legitimate concerns on the inflation stuff. Now, technically, because tariffs are a tax, they're technically one-time in nature. But if you muck up the world's supply chains because of all this, then there is potentially a multi-year flow through that is right now tough to gauge, but still a high possibility. I mean, if you're the central banker and you hear about companies that are raising prices 5, 6, 7, 8%. I mean, Mohawk Industries on Friday, the big floor covering company, whether it's hardwood floors or carpet, whatever, 8% is what they said they're raising prices right now. Now, again, yes, that can be one time. But if you're a central banker whose main goal is price stability, and you hear about that, that probably gives you cold feet in wanting to cut interest rates.
Yeah, but Peter, going back to last September, the 50 basis point cut was the first time, I want to say, in 4 years since the Fed started lowering interest rates during COVID. That was a worry about a job market that was weakening, and thus you would have an economy that was weakening here. And when you think about the 100 basis point cut they had, it just seems like there's something at odds with the current environment. If you think about, because aren't we on better footing right now? I mean, like, I'm kind of playing devil's advocate a little bit here. I know there was a lot of folks who thought that was very political. I did not think it was at the time, but the Fed has to work on the data that they have right now. And the problem that they have is that the uncertainty of the trade and the tariff situation is the thing that's keeping them on the sideline almost a year from the point in which they started cutting interest rates again.
Definitely, I agree. But from their perspective, when you have a one handle on GDP growth, your antenna has to be up for trying to prevent that from turning into a zero or negative number. And I think that is what the Fed is focused on. And with the recent jobs data, while the unemployment rate has stayed low, a lot of that is because the labor force is contracting, whether that's due to deportation slash immigration policy or whatever. The pace of hirings has clearly slowed, and the Fed sees that as well. So that's why I think that if the Fed cuts this year, which I do think they will, we have to look at it as this is a tweaking cycle so far. Yes, they cut 100 basis points so far, but the way they did it and then just stopped, and I said it back then, this is not the beginning of a trip down to zero interest rates again. This is a tweaking cycle. So if we get a rate cut or a second one this year, and maybe even another one next year, well, we'll see who the next Fed chair is. This is not just a trip down to zero. These are tweaks more than anything. And with the continued risk that long rates sort of take away the beneficial impact of a cut in short rates, just as it did in the latter part of 2024. And even to this day, 12 months ago, the average 30-year mortgage rate was about 680 to 685. Today, the average 30-year mortgage rate is about 680 to 685, and that's with 100 basis points of Fed rate cuts.
Yeah. And, this week on the data front, I mean, the fact that we have GDP, PCE, and jobs is pretty fascinating with the Fed meeting right in the middle of that. Just on the employment front for a second, you just mentioned deportation. If you think about DOGE and just basically all the job cuts we're seeing on the government side, that's been obviously a huge part of the employment picture over the last, call it, few years or so. And then the last piece is AI. And I know you've been listening to all these conference calls and you've been seeing a lot of the chatter about this. It seems like there's a healthy debate what AI is going to mean, for job losses in the future. I think we can all kind of look around and say there's plenty of jobs in the government that probably didn't need to exist. There's plenty of entry-level jobs in the private sector that don't need to exist, and that, all of these things smashed together are going to create a situation that is going to be really hard to track the employment picture. Is that fair to say a little bit in the mean term?
Yeah, absolutely. I hearing from company executives, and it's interesting, some of the things that I've heard. On one hand, the developers of these AI models, in terms of AI maybe replacing some coders and other technology type jobs of the companies that are creating the AI models. And then you have the rest of us who are using Gen AI, if we are, and trying to integrate that into our businesses. And I differentiate that because on the latter, Robert Half, which is a staffing company, if there's ever a company that wants to look in the mirror for threats to their business, it's potentially Gen AI, where if companies are hiring less, well, then you're going to need Robert Half's staffing business less. So what they did was they looked at all the different jobs that potentially could be disrupted by this current iteration of AI, and they did an analysis, and they spoke to a lot of customers that were in these businesses, and their customers told them, no, not yet have we seen any notable impact from AI to the jobs that are being used and created and utilized in these industries.
Yeah, what's interesting, and this is purely anecdotal, but last night on Sunday I went to see the Fantastic Four with my wife, and it's good. It was good, and it's a Marvel movie, and they have those post-credit scenes, and so my wife and I sat there waiting for the post-credit scene, and there were probably 1,000 names. This is no joke, that were in the credits, okay? And I'm saying to myself, I'm just looking at the job after job after job. And you think about it, this movie was probably 75% shot in front of a green screen, maybe more. If you think about all the graphics that go into it, right? Like again and again and again, I have to think like Industrial Light and Magic and all these, shops that are created to kind of do this sort of stuff. And they're all, if you're, Marvel, you're owned by Disney and, all the, I got to think that there's hundreds of these credits that are going away. Like think about that. Like it just seems odd with like generative AI. And so obviously that's one of the biggest fears in an industry, an artistic industry, like the movie industry or whatever. So it's just funny because just go look around all over, and you just say to yourself, holy shit, that can be done with that can be done with it, that sort of thing. So it's just, I think we're going to see more and more examples of this, but Robert Half, they're probably talking their own book right there. Yeah,
no, very possible. And it could be just a timing thing. That maybe it hasn't changed yet, but 2 quarters from now, they should redo that survey.
All right, let's talk earnings for a second here. And I know this is kind of getting boring for you folks there. Like, we have Meta, Microsoft, Amazon, and Apple. And those are, obviously 4 of the biggest ones here. Expectations, Peter, are high. The stocks have all run into this sort of stuff. If you think about Google, the number that they put up and the guidance that they gave, it should have been the sort of thing that made people feel pretty decent about the state of this generative AI trade, whether it was the cloud business, whether it was the integration of the models, the development, the competitiveness, the defense of their kind of search ad revenue and the like here. But the stock has not traded well. And then last week you had IBM, you had Intel, you had Netflix, you had Texas Instruments, ASML. These are all big tech stocks that had really big downdrafts after their earnings. Tesla thrown in there too, but it's filled in that gap. What are your expectations for these 4 stocks? And do you think they have the ability to kind of cause another leg higher? Carter Braxton Worth was on the market call with Guy and myself earlier today on Monday, and he showed us some charts. The S&P is obviously broken out above its prior all-time high. The Mag 7 index has not. It's at those prior highs. So you've seen a broadening out to some degree. I think financials have helped that. Industrials have helped that. There are a couple other sectors here. So curious as your thoughts as we get into 40% of the S&P 500 earnings this week.
So a couple of things. The Mag 7 as a group has definitely splintered. If you're going to buy stocks within that group, you have to be definitely more selective. I think with Google, they while the numbers were definitely comforting, for those that were worried about some of their big picture business risk, I don't think they fully put aside those major risks to their search business. Secondly, raising the CapEx to $85 billion, well, that's 25% of revenue. These businesses, as phenomenal as the models are, business models are, that's 25% of revenue. Just head-scratching type CapEx numbers, and these are now capital-intensive businesses. And if the market's reaction to Google on that CapEx increase is any indication, there could be further pushback against Meta and Microsoft in terms of their CapEx spend, and also Amazon as well. Meta, not just on building out their models, but the amount of money they're now spending on talent is now raising the bar for their capital spending. So when you're talking about 25 to 30 to 40% of revenue in CapEx, these become different cash flowing business models. And I think that you named a bunch of names that sold off after numbers, and this could be just another example of that. The bar was high going into earnings season. And what's interesting in terms of the stock market performance, we've been doing this long enough, is you'd rather buy a stock that's down going into numbers than one that is rallied 30% going into numbers. Usually there's some mean reversion there. And if you take the S&P earnings so far this season, outside of telecommunications, or I should say communications and tech, earnings for the S&P 500 is up less than 1%. So it's all these big names that making, to your point, this week so important for the entire market.
All right, one last thing on valuation. If you're thinking about the equity risk premium of the S&P 500, it's pretty astounding right now. It's basically at zero. So what do you take away from that? No one cares about valuation, but that is one valuation metric that's probably one of the most important valuation metrics. You would agree with that?
Definitely. Valuations don't matter until they do, I always like to say, but just one metric. For those of us that lived through the late 90s, in March 2000, the 12-month forward earnings multiple on the S&P 500 was 24.5. Today, it's 23. So can we continue to have multiple expansion? Yes, but we are in rarefied air. When it matters, I have no idea, but I do know there's no margin of safety right now.
All right. Well, I am in rarefied air when I'm with you, Peter Boockvar of OnePoint BFG. I really appreciate you being here. We had a little verbal book report here, so I hope we can do this every week. I appreciate your time, man.
I'd love to. Thanks for having me.
All right. Thanks, Peter.